Welcome to the Deep Dive. Today we're opening up the stacks of financial filings, analyst reports, and proprietary research you've sent our way. Our mission, as always, is to give you a really thorough, accelerated understanding of what's happening with one specific company.
And today, that company is Viper Energy, ticker VNOM.
That's right, but we are absolutely not starting with their Q3 earnings or some dry financial statement. We are starting with a signal. A massive blinking light from the world of what you'd call smart money.
A really big one.
Okay, let's unpack this right away. When you track the best contrarian value investors, I mean, few names carry more weight than Howard Marks.
For sure. He's a legend.
And Marks has just made a huge, decisive move. He has significantly augmented his position in Viper Energy.
And, significant almost feels like an understatement here.
It really does.
We're talking about a stake that's now valued at approximately $240 million.
Yeah.
But here's the crucial part. It's not just a tiny position he's building on the side.
Right. This isn't pocket change for him.
Not at all. It represents 5.07% of his entire portfolio. 5%. For a manager who is known for being so selective, so deep value-oriented, and, a master of cycles.
To commit over 5% of his capital to a single energy royalty company.
It just screams profound confidence. It's a huge tell.
And that's our starting point for this whole deep dive. When a guy like Marks moves that big, he isn't just betting on a little bit of volatility or some marginal trade. He's positioning for something bigger.
He's positioning for a fundamental transformation, a massive re-rating of the asset's value.
Exactly. So our goal today is to explore why this specific transformation, the company's recent strategic moves, and its very rigid financial roadmap is set to completely redefine where VNOM stands in the market.
And what's so fascinating here, and I think this is what Marx probably sees, is that the thesis, like you said, isn't predicated on just hoping for some geopolitical event that sends oil prices to, $120 a barrel.
No, it's not a hope and a prayer kind of bet.
Not at all. It rests on a specific, a near-term, and most importantly, a controllable financial threshold that the company's management is just rapidly approaching.
Okay, so before we get into the weeds on that, let's set the context for everyone listening. What exactly is VM?
So VMM is a really fascinating entity. It's what's called a pure-play Permian Basin mineral and royalty interest holder.
Right. So let's break that down. What does royalty pure play actually mean in practice?
It means they operate under what's called an asset-light model. They primarily collect payments royalties from the oil and gas that's produced on their land.
So they're like the landlord.
A very well-paid landlord. They typically get a cut of, say, 12.5% to 25% of the gross revenue from every barrel that comes out of the ground.
Okay, so they own the land rights, but they're not buying the big drilling rigs, they're not hiring the crews, they're not maintaining all that expensive equipment.
Precisely. They are the silent partner in the well. They collect all that top-line revenue without bearing the incredibly expensive capital-intensive burden of drilling or operating or maintenance costs.
And they don't have to deal with soaring costs for steel or services either.
Not at all. And that inherently leads to this beautiful high-margin, high-cash flow business structure. The entire investment thesis, the one that Marx is so clearly anticipating, is tied directly to the execution of their debt reduction plan.
Which then triggers a huge change.
A permanent, highly beneficial change in how the company returns nearly 100% of that massive cash flow back to its shareholders.
That clarity on the goal is really essential, but to even get to that goal, the company first had to completely reshape itself.
It really did.
So to understand that roadmap, we have to look back at the really dramatic strategic changes the company went through, especially around the third quarter of 2025. This wasn't just some minor portfolio shuffling.
Oh no, this was a fundamental reshaping of the company's entire structure and scale. A true corporate pivot.
So what was the headline move?
The headline event was the massive $4.0 billion all-equity acquisition of Sichio Royalties Corp.
An all-equity deal. That's interesting.
It is. It closed on August 19th, 2025. And this was a deal that was specifically structured to achieve one thing: massive, immediate scale, right in the heart of the Permian Basin, where Viper was already a dominant player.
So they were doubling down on their core strengths.
Exactly. Post-acquisition, the total consolidated mineral and royalty footprint became absolutely enormous, reaching roughly 95,846 net royalty acres.
Wow.
But here's the thing. Size isn't everything in this business. What's really critical is the quality and the complementarity of the assets they bought.
So were they good acres?
They were fantastic. The Sichio acreage was highly focused. It featured roughly a 50% overlap with Viper's existing gross-producing horizontal wells in the Permian.
50% overlap, what does that tell you?
It tells you the assets weren't scattered across some lower-tier counties or fringe areas. They were concentrated in the absolute core development areas of the Midland and Delaware basins, the sweet spots.
Which ensures the inventory is long life and high return.
That's the key. They bought quality, not just quantity.
So they acquired scale, and they concentrated their assets in basically the hottest oil patch in North America. But that consolidation, that was only one part of this surgical maneuver, right?
That's right.
The immediate countermove, the strategic shedding of their non-core assets, is arguably just as important for driving that valuation premium we're talking about.
It really speaks volumes about management's discipline. The strategic realignment wasn't just about getting bigger. It was about getting purer and financially cleaner.
So what do they sell?
Almost immediately after the Sichio deal closed, VM turned around and agreed to sell off all of its non-core, non-Permian assets.
Everything outside the Permian.
Everything. Their positions in the DJ Basin, the Eagle Ford, the Williston Basin.
Yeah.
All of it. Gone. For a really robust all-cash price of $670 million.
$670 million in cash. That's a huge injection.
It is. And this capital recycling strategy
Yeah.
is the absolute key to accelerating the whole thesis. Think about it. They used their equity to buy massive scale in their core domain, the Permian. Then they immediately pruned the less desirable non-Permian parts of the portfolio that, required management attention but didn't really justify the same high valuation multiples.
And that's $670 million in cash. That streamlines the entire portfolio into what investors call a Permian pure play model. I have to ask, though, why is focusing solely on the Permian so critical? Why would that justify a potential premium valuation from investors? Why not just hold on to the diversified assets for a little, safety?
That's a great question, because diversification is usually seen as a good thing. But in this sector, investors often apply a discount, sometimes it's called a conglomerate discount, to companies that operate in a bunch of different disparate basins.
So it actually hurts their valuation.
It can. It increases complexity, it adds operational risk, and it makes it really difficult to compare them to their peers. By focusing strictly on the Permian, which is the highest margin, highest activity basin in North America, with decades of proven inventory.
They simplify the story.
They simplify the story completely. It tells the market, we are the single best, highest quality royalty vehicle in the world's most important energy region, period.
And that simplification and focus, that's what reduces the discount and justifies a premium multiple.
Especially when you combine it with the massive scale they now have. It's a powerful 1-2 punch.
And we can already see the operational validation of this bigger and purer strategy in their production guidance, right? The step change in expected production is huge, which is obviously vital for feeding that future high dividend.
It is a phenomenal immediate step up. If you look at Q3 2025, their average production was 108,859 barrels of oil equivalent per day, or BOED.
Okay.
But the guidance for Q4 2025 is projected to be substantially higher. They're guiding to a range of 124,000 to 128,000 BOED.
That's a massive jump quarter over quarter.
It's a huge year-over-year increase, and it just confirms the immediate accretive power of integrating those Sichio assets. It's not some marginal improvement.
No, it's a structural reset of their entire production baseline.
It is. And critically, management is confident this isn't just a one-time peak. They are projecting mid-single-digit organic growth in 2026 relative to that new high Q4 2025 baseline.
Which suggests they can keep outperforming the natural decline curves that are just inherent in the energy business.
That's right. And that scale and that growth are absolutely necessary to maintain that future high yield we've been talking about.
Okay, that discussion on organic growth really sets the stage perfectly. Strong, steady production provides the cash flow. But this brings us to what you called the linchpin, the core of the Marx thesis, and really the true aha moment for anyone listening. This is where the financial strategy becomes almost like a binary switch. The company has set a hard-defined financial goal for their balance sheet health that is inextricably tied to maximum shareholder distribution.
This is the absolute linchpin of the entire investment. Management has explicitly linked their most generous shareholder distribution policy, that shift to a nearly 100% payout, to achieving one specific goal,
which
getting net debt at or below the critical $1.5 billion threshold. It is a clear, quantitative, and very public commitment.
Okay, so let's look at the numbers from the latest filing. Where do they stand right now?
As of September 30th, 2025, the consolidated net debt stood at approximately $2.2 billion.
So $2.2 billion, that means they were about $700 million away from that target.
Exactly. And if they were just funding that solely by retaining their cash flow, it might take several quarters, maybe a year, depending on oil prices.
But this is where that divestiture comes in.
This is where the divestiture becomes the acceleration factor that Howard Marks is absolutely betting on.
Right. So let's map out that acceleration. The expected $670 million in proceeds from selling those non-Permian assets is the game changer.
It is.
If you take their starting point of $2.2 billion in debt and you subtract that $670 million in cash,
Leverage immediately drops to approximately $1.53 billion.
$1.53 billion. That puts the $1.5 billion target within clear, imminent sight. It's right there.
It completely changes the risk profile of this bet. Instead of relying on, say, a half year of commodity price stability and flawless operational performance to generate $700 million in retained cash,
The divestiture just covers almost the entire gap in one shot.
the remaining $30 million is, that's easily achievable through just one quarter's worth of retained cash flow, even if the divestiture proceeds arrive a little late, which is expected sometime in Q1 of 2026. This transition is no longer a question of if,
It is when.
just when.
Okay, but let's be critical for a moment and address the timing risk. What if that $670 million asset sale gets delayed? Say there's an unexpected regulatory hurdle or the buyer has a financing delay in Q1 2026. Does that completely derail a 100% payout timeline?
That's a very fair question. And the answer is no. It would delay it slightly, but it wouldn't derail it. And here's why.
Okay.
Even without the full $670 million hitting their bank account immediately, the company retained approximately $30 million of distributable cash flow in Q3 2025 alone.
Right.
And with that massive production step up we're expecting in Q4, that retained cash flow number is only going to grow.
So they're still chipping away at it organically.
They are. So if the sale proceeds are delayed by a quarter, management would still be able to cover that last $30 or $50 million gap pretty quickly, just using the operating cash flow they generate in Q4 2025 and Q1 2026.
So the sale just provides certainty and pulls the timeline forward.
It provides certainty and it accelerates the timeline to near immediate execution once it closes. The key point is that the goal is no longer contingent on sustained high cash flow. It's nearly guaranteed by that asset sale cash injection.
That acceleration factor is the engine driving this whole valuation story. So now let's detail the return of capital framework itself. What is the policy right now, and what does that shift actually mean for the cash that investors receive?
Okay, so currently the framework mandates that they distribute at least 75% of what's called cash available for distribution, or CAD.
And CAD is that non-GAAP, real distributable cash flow number we'll dig into more later.
That's the one. In Q3 2025, they were being very aggressive with retaining capital for debt paydown. They paid out $83 per share.
Okay.
And that represented 85% of the pro forma CAD, which was $97 per share.
So that 15% difference between the 85% they paid out and the 100% that they generated.
But that was the cash they retained. About $25 million in cash, specifically to chip away at that $700 million debt gap.
Okay, so that's the before. What's the after?
The imminent shift is that once they meet that $1.5 billion net debt threshold, the commitment escalates. It jumps to returning nearly 100% of CAD to stockholders.
Wow.
And that transforms the stock overnight from, a good growing dividend payer into a top-tier maximum income vehicle.
Let's quantify the yield impact, because a 100% payout in a company with this kind of operational efficiency, that has to be huge. This is the metric that Marks and any future institutional buyers are going to anchor their valuation on.
Absolutely. And we have to stress this is based on current projections, of course.
Of course.
But the modeling suggests that even at a conservative WTI price floor of, say, $60 per barrel, which is well below recent trading prices, the company is expected to generate greater than $3.55 per share in annual distributable cash flow.
$3.55 per share.
At least. Now, if you take that projected $3.55 plus per share and you mandate a 100% payout based on the stock price as of October 31st, 2025, which was $37.56, that translates to a highly attractive forward cash yield of approximately 10%.
A 10% yield on a high-quality Permian asset base with superior inventory visibility and an asset-light structure that protects you from cost inflation.
It's a really powerful combination.
That's a different class of investment.
It is. It's the difference between being just another energy commodity proxy and being a premium financial instrument. That 10% yield level fundamentally shifts institutional mandates.
What do you mean by that?
It changes who is allowed to buy the stock. It moves it from just specialized energy funds into broader income and yield-focused institutional portfolios.
Right.
This is the financial aha moment that Howard Marks is anticipating. The moment that current temporary capital retention is replaced by maximum distribution.
But the return of capital strategy isn't just about the mandatory dividends, is it? They also use share repurchases as a supplemental, more opportunistic strategy. How does that fit into the framework?
It fits in as a highly flexible and, I think, very smart component. Management views the share repurchase program as countercyclical.
So they buy when the stock is down.
They use it opportunistically during periods of what they perceive as market dislocation, which is just a fancy way of saying when they feel their stock is significantly undervalued relative to the underlying assets and that upcoming catalyst.
And we've seen them do this recently.
We saw this active management in Q3 2025. They repurchased 2.4 million shares for $90 million at an average price of $38.42 per share.
So they're buying pretty close to the current price.
They were, and they're still actively using this program. They repurchased another 860,000 shares through October 31st, 2025.
And what's the remaining capacity on that buyback program? How much more can they do?
It's substantial. They still had $302 million remaining authorized under the total $750 million repurchase program.
So they have plenty of dry powder.
They do. And this combination, a mandatory high-yield dividend policy that's triggered by debt reduction, supplemented by an aggressive, opportunistic buyback program, it enhances the per-share metrics and the total shareholder return profile.
It's an effective way to communicate to the market that management thinks the stock is cheap while they wait for that debt target to unlock the main yield catalyst.
That's exactly it.
Okay, now let's drill down into the underlying operational stability. Because without durable, reliable production, that 10% theoretical yield is just that. It's theoretical.
Right. It has to be backed by real barrels.
And the operational strength here really stems directly from the incredible efficiency of that asset-light royalty model itself.
This is where we need to just reinforce the unique financial advantage they have. A royalty company like VNOM inherently benefits from a cost structure that is virtually impossible to beat in the energy sector.
Okay.
We are looking at an effective 100% gross margin.
Help the listener understand that. Why 100%? That sounds impossible.
It sounds crazy, but it's because the royalty holder, Viper Energy, receives a percentage of the gross revenue from the oil and gas produced, but the operator, the drilling company, bears 100% of the associated costs.
All of them.
All of them. The drilling costs, the completion costs, the maintenance, the personnel, the rising costs of steel and labor, all of those are on the operator's books. For Viper, their capital expenditure, their Capex, equals zero.
Zero.
Zero. And this specific model makes them a perfect asset-light inflation beneficiary.
Unpack that term.
Well, in an environment where energy service and drilling costs are just soaring, VNOM doesn't absorb any of those inflation-driven costs.
Right, because they don't have any.
But their revenue still increases if the underlying commodity price goes up. So they get all of the upside from commodity inflation with none of the exposure to capital cost inflation.
And their actual cash costs, the money they spend to run the business, confirm this efficiency perfectly.
Absolutely. Their full year 2025 guidance projects, cash, general, and administrative expenses, that's the actual money VNOM spends on overhead, salaries, administration, at an exceptionally low range of just $0.80 to $1 per barrel of oil equivalent.
$1 per barrel. That's it.
It's barely anything. And that minimal G&A ensures that nearly all the revenue, after you subtract those minimal cash costs and taxes, converts directly into that high-quality operating cash flow we call CAD.
And they're getting more efficient, too.
They are. Their total operating expenses on a per-BOE basis were just $3.50 in Q3 2025, which is highly favorable compared to $4.60 in the year-ago quarter.
So that drop shows they successfully integrated Sichio while actually achieving immediate scale efficiencies, lowering the blended per-unit cost.
It's a textbook example of a successful accretive merger.
Okay, let's move to activity and production visibility. The royalty model, as we've said, relies entirely on the development decisions of the operators on their land. So how high is the visibility into future production volumes, and why is that superior to a traditional E&P company?
The visibility is perhaps the single best competitive advantage in the entire sector. Think about it. A traditional E&P company constantly has to prove it can find new wells, it has to go out and secure financing to drill them.
It's a lot of execution risk.
A ton. A royalty company just sits back and watches the best operators in the world build wells for them. And if you look at the sheer volume of activity underpinning that organic growth forecast, it's just staggering.
Give us the numbers.
In Q3 2025 alone, 739 gross horizontal wells returned to production on Viper's acreage.
739 in 1 quarter.
In 1 quarter. And that translates to 15.2 net 100% royalty interest wells. It's a massive volume of activity that ensures sustained, reliable cash flow.
And the inventory deep dive, that really reveals how that activity translates into guaranteed future production, doesn't it?
It does. It's not speculative. As of September 30, 2025, they had 1,947 gross wells, which equates to 38.8 net wells in active development.
And what does inactive development mean?
These are wells that are already designated as work in progress. They've been drilled, they're being completed, or they're just waiting for the final hookup. They are expected to be turned to production, or TTP, within the next 6 to 8 months.
So that's essentially guaranteed production growth for the next 2 quarters.
It is. That massive 38.8 net well inventory directly supports that organic growth projection. But the visibility extends even further out than that.
Really?
Oh, yeah. They have an additional 1,664 gross wells, or 36.3 net wells, that are identified with line-of-sight potential. These are expected to turn to production within the next 15 to 18 months.
So they can see production coming online a year and a half out.
Exactly. This large, well-documented backlog just provides superior visibility into future production volumes, and it significantly reduces execution risk compared to an E&P company whose inventory is far less certain.
That inventory visibility is gold. But we do need to address the operator dynamics. Viper Energy's relationship with its parent company, Diamondback Energy, or FANG, is key. But doesn't relying so heavily on FANG sound like a concentration risk? How diversified are they, and is that dependence still a vulnerability?
The relationship with Diamondback is definitely a unique competitive advantage, as long as FANG maintains its high capital expenditure program, which everyone expects it to do. FANG operated 124 of the gross wells turned to production in Q3 2025.
Okay.
And Diamondback remains the primary driver of net oil production. And that's because Viper holds a much higher average net royalty interest on the wells FANG operates.
How much higher?
It's about 5.6% for FANG-operated wells compared to just 1.3% for third parties. So when FANG drills, Viper benefits disproportionately.
And that relationship gives them an inside look, right?
It does. It grants Viper specialized visibility into FA's future development plans. They effectively get a look at the drilling schedule before the public does, which provides a layer of certainty that many of their pure royalty peers just don't possess.
And they're aligned financially, too.
Very aligned. FANG holds about 42% of Viper's outstanding common stock, so that structural alignment mitigates a lot of the risk, because FANG benefits directly from VM's success.
But let's push on that. How confident can we be that their consolidated third-party exposure truly mitigates that concentration risk if, for example, FANG decides to slow down its drilling budget for some reason?
That's where the Sichio acquisition really paid off. The consolidated portfolio significantly broadened that third-party exposure, especially in the core Permian regions.
So they're not just a FANG story anymore.
Not by a long shot. In Q3 2025 alone, 615 gross wells that were turned to production were operated by third parties, companies outside of FANG.
615. Wow.
And here is the key market statistic. The combined expanded acreage position has consistently captured almost half, nearly 50% of all third-party development activity in the entire Permian Basin since the start of 2023.
Wait, say that again? Half of all third-party activity in the Permian.
Nearly half. Capturing that much external development proves that the quality of their acreage is non-operator dependent. The best companies are drilling on their land because that's where the best rock is.
That's a staggering statistic. Capturing nearly 50% of third-party activity is huge. It means they have robust diversification away from their parent company, but they still retain that highly visible FANG development in their core areas.
It's a very smart blend of reliability and market dominance.
The operational floor is just incredibly high, which makes that cash flow we were talking about highly predictable.
That's the takeaway.
Okay, let's transition now to the financials, because for the uninitiated, or really for anyone who is only glancing at the headlines, the Q3 2025 results might have been confusing.
Alarming. Yeah.
Alarming, yeah. There was a major red flag in the GAAP headline number that needs a very detailed explanation.
It's absolutely essential to address this. The company reported a consolidated net loss of $197 million. A net loss of 52 cents per share attributable to common shares. Now, if you're just reading that headline, it suggests the company lost nearly $200 million, which completely contradicts the strong operational performance and the high revenue figures we just spent all this time discussing.
So what does this all mean? Why the substantial net loss, especially when they are generating so much operating cash?
The net loss was entirely non-structural. And what I mean by that is it was not caused by a lack of cash generation from the business. It was caused by large non-cash accounting charges that are unique to the energy sector, particularly after a massive acquisition like Sichio.
Okay, so it's an accounting issue, not a business issue.
Precisely. Total expenses were reported at an inflated $594 million for the quarter. And this figure was artificially blown up by two main factors. First, a monumental non-cash impairment charge of $360 million that was recorded following the Sichio acquisition.
An impairment charge is a concept that often confuses listeners. Can we just break down why a successful acquisition could lead to a giant accounting loss?
Certainly. It seems counterintuitive. Impairment happens when the value that's listed on the balance sheet of the assets you acquire must be adjusted down for accounting purposes.
Okay.
In this case, that $360 million charge was related to technical accounting rules regarding the historical carrying values of the Sichio assets, or maybe derivative pricing assumptions they used post-acquisition. The charge essentially says, for accounting purposes, the book value of these newly acquired assets is lower than what we paid for them in the eyes of GAAP rules.
It's a paper loss.
It is a paper loss, not a cash loss. They did not write a $360 million check to anyone.
Understood. And what was the second major non-cash charge that really swamps the GAAP results?
That would be depletion expense.
Right.
For royalty companies, this is a huge number. Depletion expense is basically the energy equivalent of depreciation for a factory. As a well produces oil, the underlying resource in the ground depletes. And GAAP accounting requires companies to estimate and expense this depletion every single quarter. For Viper, the depletion expense was up to $373 million for just the 9 months ended September 30, 2025.
$373 million. That is a massive non-cash expense.
It's huge. So the combination of that $360 million impairment and the massive ongoing depletion expense absolutely swamped the operational income, creating an artificial yet required loss on the GAAP books.
Which is why looking at a PE ratio for a company like this is so misleading.
Exactly. This is why their trailing 12 months price to earnings, or PE ratio, is just wildly unreliable. It has swung from a low of 6.01 to a high of 32.47 recently. If a metric is that volatile, you simply cannot rely on it for valuation.
So we have to pivot to the cash metrics.
You have to. It's the only way.
Okay, let's detail those superior cash flow metrics then. What should the listener be focusing on to understand the company's real financial health and its real distribution capacity?
The focus has to be entirely on the non-GAAP cash flow measures. First, you could look at net cash from operating activities.
Okay.
This stood at $281 million for Q3 2025. That's an impressive increase from $203 million in Q3 of the prior year. This number shows you the genuine massive amount of operational cash being generated before you get to those non-cash accounting distortions.
But there's an even better metric, isn't there?
There is. The definitive metric for gauging shareholder return capacity is the pro forma cash available for distribution, or CAD. This metric specifically strips out all the non-cash items, like depletion and impairment, and it subtracts only the necessary cash expenses, like cash G&A.
So it gives you the real distributable free cash flow, the actual money that can be sent to shareholders.
Exactly what it is. It's the number that matters.
And what did that critical metric reveal for Q3 2025?
Q3 2025 pro forma CAD totaled $165 million, or B/9 per Class A share.
97 cents per share.
And that figure strongly covered the declared base plus variable dividend they paid, which was $D$0.58 per share.
Okay, so that difference, the difference between the 97 cents they generated and the 58 cents they paid out.
That is the precise amount of cash that management chose to retain to aggressively pay down the debt and fund those buybacks we talked about.
That robust coverage of the dividend, even during a major integration and deleveraging phase, that's powerful. It suggests the base dividend is engineered to be highly sustainable.
It is. It's protected, according to management, down to extremely low WTI prices. It just proves the model.
Yeah.
When your single largest cost is a non-cash accounting expense like depletion, your reliance on high commodity prices just to survive diminishes significantly. The high cash flow conversion rate, driven by that 80 cent to a dollar per bow cash G&A, means almost every dollar of revenue hits the bottom line, ready for distribution.
So investors who only look at that headline gap loss are entirely missing the true financial strength and the imminent yield catalyst.
They're missing the whole story.
Okay, we've established the operational strength and the financial catalyst. Let's talk about managing downside risk. The energy sector is inherently volatile, and while that asset-light model protects them from cost inflation, they are still exposed to oil price drops. How does VNOM manage commodity price swings?
They use a very highly targeted hedging strategy that's designed to secure a financial floor without compromising the potential upside.
Which is crucial for maximizing that variable dividend when prices are high.
Absolutely.
Yeah.
The primary mechanism they use is what's called deferred premium WTI put options.
Okay, that phrase, deferred premium WTI put options, is a mouthful, and it sounds complex. We know a put option secures a floor price, a minimum selling price. But what exactly does deferred premium mean for their current cash flow, and why is that strategically better than a simple fixed swap for this specific catalyst play?
That's a great question because the nuance is important. In a standard put option, you pay the premium, which is the cost of the insurance, up front. Deferred premium means they don't have to pay that premium until the contract expires or until the hedge is settled down the road. And this is strategically brilliant during their deleveraging phase.
Why is that?
By deferring the premium payment, they retain the maximum amount of cash flow right now to achieve that $1.5 billion debt target faster.
Ah, so it's all about speed.
It's all about speed to the catalyst. They secure the downside protection they need for stability, but they don't have to spend the cash until later, which accelerates the timeline to the 100% CAD payout.
And unlike a fixed price swap, if oil prices go to $100 a barrel,
Their benefit is uncapped. They participate in all of that upside, which maximizes the variable dividend payout potential.
so they're prioritizing cash retention for the debt target above all else, even if it slightly increases a future liability in the form of that premium payment.
Exactly. It's an aggressive but very calculated use of financial engineering to reach that financial catalyst as quickly as humanly possible. And we can see this timing reflected perfectly in their protection schedule.
So what does that schedule look like?
For Q4 2025, they have 40,000 barrels per day protected at a $55 or car price. For Q1 2026, it's still 40,000 barrels per day protected at $51.75. So solid downside protection.
Okay.
But look at the planned reduction in coverage after that. The protection significantly drops in Q2 2026 to only 15,000 barrels per day at a much lower $47.50 strike.
So they're taking the hedges off.
They're rolling them off. And this decrease in hedging coverage is a clear signal from management. It shows they anticipate being fully deleveraged and at that 100% payout commitment by Q2 2026.
So once that target is hit, they want maximum exposure to variable dividend upside.
That's it. It confirms their confidence in the immediate future. It's a very sophisticated risk management strategy that basically telegraphs the company's internal forecast for hitting that $1.5 billion target.
Beyond managing risk, let's look at the long-term organic growth and, crucially, the structural improvements that are aimed at attracting the very institutional investor base that someone like Howard Marks represents.
The organic growth outlook remains robust, and it's all supported by that deep, visible inventory we talked about earlier. Management is forecasting mid-single-digit organic growth in 2026, relative to that new, robust Q4 2025 estimated production baseline.
And that organic growth is vital.
It's vital because it proves that the current high level of operator activity, driven by FANG and all those third parties capturing 50% of Permian development, is structurally sufficient to overcome the natural decline curves of oil and gas wells.
Which translates directly into
double-digit year-over-year oil production growth per share in 2026, which is what fuels that high-yield payment.
But the truly transformative element for the long-term re-rating is the structural change, the C-Corp conversion. This seems huge for institutional money, and it probably shouldn't be overlooked.
Absolutely. It's a massive deal. The company historically operated as a limited partnership, but it was already treated as a corporation for federal tax purposes.
Which meant they avoided the dreaded K-1 tax forms for public equity holders.
Right, which is a massive administrative headache for many retail investors and even some funds. Instead, they issued the simpler 1099 DIVs.
If they're going a step further.
They are. They announced their intent to formally convert their legal status from a Delaware limited partnership into a full Delaware corporation, which was expected by the end of 2023.
Okay.
And this conversion, coupled with the adoption of a strong corporate governance structure, is explicitly designed to meet the eligibility requirements for certain large institutional indexes and benchmarks.
Let's elaborate on that institutional hurdle. Why can't passive funds typically hold master limited partnerships, or MLPs, and why does this C-Corp conversion unlock massive potential capital flows?
So large institutional funds, big mutual funds, and especially passive exchange-traded funds, ETFs, they often have very strict internal mandates against holding entities that are structured as MLPs, regardless of the tax form.
Even if they don't issue a K-1.
Even then, MLPs often introduce complexities around something called unrelated business taxable income, or UBTI, which is an absolute disqualifier for many institutional portfolios, especially retirement funds and university endowments.
So by moving to a true C-Corp structure,
They eliminate that hurdle completely. It makes the company eligible for inclusion in major indices like the S&P Midcap 400 or the Russell indexes.
and if they achieve inclusion in just one of those,
It triggers massive passive buying pressure because all the index funds are then forced to buy the stock to track the index. This move is designed purely to broaden the potential institutional investor base, which was previously cited as being very low, and create a permanent floor for the valuation.
so they are cleaning up the corporate structure at the exact same time they are unlocking the cash flow. That convergence must be what Howard Marks is truly positioned for.
I think it has to be.
Let's close the loop on the valuation gap as it stands today. The stock was trading at $37.56 as of October 31, 2025, yet the Wall Street consensus is overwhelmingly positive.
The analyst consensus is fantastic. 100% of analysts covering the stock recommend a buy, with 31% of those calling it a strong buy.
And what about the price targets?
The key metric is the consensus price target, which is set at $55.85.
$55.85. That is a massive disparity from the current closing price.
It is. It shows you that the market has not yet fully discounted the successful execution of this financial catalyst.
And we can see that valuation suppression if we compare their dividend yield to peers.
You can see it very clearly. If you compare the company's current trailing 12 months dividend yield, which is about 6.05%, to a high payout peer like Kimball Royalty Partners, KRP, which has a yield closer to 12.8%.
That's a huge gap.
And the difference is that 15% of cash flow that VM is temporarily retaining to hit that $1.5 billion debt target.
So the current lower yield is structural, it's temporary, and it's essentially the cost of admission to get into the future 10% yield party.
That's the perfect way to put it. The successful deleveraging driven by that retained cash flow plus the $670 million asset sale is the catalyst for a fundamental re-rating of the stock.
Yeah.
Once they achieve the 100% payout and the stock becomes index eligible via the C-Corp structure, the yield should jump dramatically, closing that valuation gap and pushing the stock toward or even beyond that consensus target of $55.85.
And the premium valuation is fully justified?
It is. It's justified by the pure play focus on the Permian, the superior organic growth, and that clear imminent shift to maximum yield distribution.
So if we were to summarize the entire transformation of Viper Energy, it really seems to rest on three main pillars, and they're all converging in the very near term.
That's right. First, you have the strategic transformation into a Permian pure play, which they achieved through that accretive Sichio acquisition and the swift, disciplined sale of their non-core assets.
Pillar 1, focus and scale.
Pillar 2 is the accelerated financial catalyst. The near imminent achievement of that $1.5 billion net debt threshold, which is the trigger that flips the switch to a nearly 100% CAD payout, setting up that 10% forward yield floor.
And pillar 3.
Pillar 3 is the operational stability. It's secured by that unique Diamondback relationship and the superior, well-documented inventory visibility that guarantees mid-single-digit organic growth for years to come.
And it brings us right back to our initial hook, Howard Marks. His augmented position, that 5% portfolio weight, suggests profound confidence not just in the high quality of the underlying mineral assets, which are clearly world-class,
but in the near-term execution of this defined, measurable financial strategy.
He's betting that management meets their goal in Q1 or Q2 of 2026, turning what is today a high-potential stock into a high-certainty income vehicle.
That's the bet.
And the final provocative thought for you to consider is the true implication of that structural cleanup we talked about. The C-Corp conversion, coupled with the forecast for sustained organic production growth and that careful use of deferred premium hedging to protect the downside price risk, It fundamentally changes the narrative of this company.
Yeah.
What stands out to you is the potential for VNOM to transition from being merely a volatile commodity exposure play, a company you just watch the price of oil to trade, to becoming a premium, high-yield income vehicle designed explicitly for a massive, index-based institutional audience.
It becomes a core holding.
Exactly. That transition from a cyclical commodity trade to a must-own income stock is a powerful momentum shift that is rarely this clearly signaled in advance.